Hi, David and I hope you guys are having an absolutely fantastic day. We're excited to bring you another one of our educational videos.
Today, Harry and I will be talking about a common topic of conversation that we have with our clients. What is a better investment, real estate or the stock market?
There is no question that investing in real estate is often a good investment. Real estate, especially in the major urban Canadian cities, has been a relatively stable investment that has provided solid mid-single-digit average growth rates. But while real estate is a good investment, there is lots of data available which indicates there are better investments than real estate. The reality is that over the past 25 years, the Canadian stock market has nearly doubled the average return of Canadian real estate. The S&P TSX over the past 25 years has averaged 8.3%, while the national average of Canadian real estate has averaged 4.5%. Being that many of our clients live in and around the Vancouver area, they often tell us Vancouver real estate has been a particular exceptional market. While Vancouver has certainly been an above-average market, its average return of 5.2% is still far lower than the Canadian stock market at 8.3%. Moreover, the best actively managed stock funds have beaten the market return of 8.3% over this period.
So why is it that so many people believe that real estate is the king of all investments, even though historical data indicates otherwise? Well, first off, most real estate purchases are typically highly mortgaged, which can magnify gains. In Canada, it's not uncommon to see loan-to-value ratios of 80% or more. By contrast, equity market investments are typically not purchased with borrowed funds. When you borrow funds to make an investment, if that investment is profitable, the profits are amplified to the extent that the investment is leveraged by borrowed money. It is more commonplace for a bank to lend individuals money to buy real estate than for stocks. As a result, people see amplified gains on their real estate due to leverage, which often leads them to think that their house is growing better than their investment portfolio, which in most cases isn't actually true. Another thing that many people fail to consider when comparing real estate to investments is the costs involved with real estate. There are real estate commissions when you buy and sell, land transfer taxes, annual property taxes, and maintenance and repairs that are not included in the data represented in the chart on the previous screen. The standard deviation, or volatility, of real estate versus stocks is another key consideration. Stock markets often have greater extremes in terms of volatility compared to residential real estate. Sometimes people end up making more money in real estate than in stocks simply because they are less likely to make a poor emotional decision at the wrong time. For many people, it's easier to avoid the temptation to sell real estate when the market is down for a host of reasons. Real estate is less liquid than stock investments. Therefore, it's harder and more time-consuming to sell a property than sell an investment fund, which makes it easier for people to avoid selling at the wrong time with real estate.
When deciding between investments in real estate or equities, it's important to keep in mind that the best asset class for you will depend on your own unique investment goals, time horizon, and risk tolerance. Beyond the growth alone, there are tax implications to consider when weighing real estate versus traditional investments that only a detailed analysis of your personal situation can uncover. As for most things in life, often balance is the best option for most people.
We hope today's video provided you some good food for thought, and we would welcome any questions that you have about your investments.
Have a great day.